I just gotta say, Valuetainment's the best like financial like show that exists on the internet right now by far. I pick up so much, even for like scripting for my clients from PBD. It's incredible. This dude's awesome. So let's react to his reaction to the housing market, because I think his take on the housing market's a little different than mine.
Goldman Sachs predicts that home prices will sink 19% in Austin, 12% in Seattle, 16% in Phoenix, 15% in San Francisco by late 2024. Goldman sees a 6.1% decline in home prices nationwide for 2023, which could be attributed to Federal Reserve's aggressive rate hiking cycle. Housing affordability is currently at historic lows, and buyers are starting to gain more purchasing power and potential.
Okay, I'm going to take over Tom's analysis here because I'm sure Tom is great, but just want to react to that article that PBD dropped. First off, we're in Southern California, so we have a very different real estate economy than the entire US. So my opinion is very biased on the Southern California market because that's what I know and that's what I'm ingrained in. So here's some issues with that Goldman Sachs report. I'm going to just talk about somewhat of the reality of what can happen, and then I'm going to give you my opinion at the end, because I'm going to give you the markers to look out for a potential price drop in the housing market. But I think my take is very unique, unlike a lot of these guys are looking at. So people like putting out negative content. That's just it. That's what gets the most clicks. That's what gets the most views. So there's a lot of bias on what's being projected in the housing market and the economy. So let's just take that and try to use data, right? So when they talk about these percentages of whether it's 12%, 18%, some of these major metropolitan areas like Dallas, Austin, Seattle, yes, very likely you're going to see price drops, but it's at what price point will the price drops happen? And I think that's very important to distinguish, because the people that aren't making moves are the people that are pretty well off. And so the average age of a buyer is about 30 years old. They're the millennial generation, but the average age of a seller is in their 50s. So what the article failed to address is why supply is so hampered right now. Trillions of dollars, and the majority of household owners refinance between 2020 and 2021 because rates were in the 2s and 3s, right? A $500,000 mortgage was about $2,500, where now $500,000 mortgage is about $4,500. And so because of the higher interest rates, right, and the higher monthly payment, people are projected not to be able to afford the $500,000 home. But you also have the millennial generation is also like higher earners per capita than like any other generation. So they're able to afford more, so likely they're able to afford a bigger payment. There's also a lot of cohabitation going on where multiple people are coming together to be able to afford that increase in the monthly payment. My challenge on why I don't think you're going to see that significant of a drop, especially not something like 19% in any major area, specifically in price points between say 100,000 and 700,000, is because of what I just said with the lower interest rates. People aren't going to want to get out of a $2,500 monthly mortgage. They're just not. Therefore, there's going to be a very limited supply because sellers aren't going to move unless they absolutely have to. So here is like 3 things that might make a person move, right? Like death of a family member, a divorce, right? And typically the third would have been a downsize, right? Older couple, 4-bedroom house. They got 2-story house. They don't want to walk up and down the stairs. They want to go into a bungalow. These are the people that probably aren't going to be willing to sell right now because they have a ton of equity, their mortgage payment's low, and if they go buy another house, they're not going to be able to maintain the same cash flow because no matter what, their payment's probably going to get driven up because the mortgage rate increased by 3 and sometimes 4x. So death and divorce really are the 2 biggest factors that are going to go into a person selling their home or a kid getting kicked out of school, right? There's going to be a lot of purpose-driven moves. Other than that, I don't foresee a big influx of supply. And because the supply is going to be hampered, you're still going to have a pretty big demand of buyers. And even though they may not qualify, right, for a ton, those price points, 100 to 7, it's pretty easy to pull in another borrower and get that home. And you also have more aggressive programs with rate buys downs. And I predict that at some point, we're going to see a 40-year mortgage, just like the auto industry went from a 5-year term to a 7-year term like that, because people care about monthly payments and not about the overall cost. Where I think this article is accurate and PBD is accurate is in the higher price points, the 1 million plus, the 800, 900 million, 2 million. Those price points, that increase in interest rate doesn't translate to $1,000, $2,000. You're talking maybe $3,000, $4,000, $5,000 of an increase in payment. And those type of buyers are a little bit more savvy. And so they're all holding their money. Warren Buffett has $105 billion just he's sitting on. Well, that's because he's savvy. He knows that things are gonna drop, and when things drop, that's when he's gonna go buy. Those higher niche, those luxury market price points, those probably will see a 20% decline. The lower price points, I think, are gonna continue to be stagnant or even go up a little, right? And that's very controversial right now to say that home prices are gonna go up. But I can tell you that anybody who's positioned in a $300,000 to $500,000 house in one of the major cities, whether it's Seattle, whether it's Los Angeles, anywhere in Southern California, you're probably in a position where your house is still gonna go up because that's what people can afford, right? The people who are qualified for 800 now are looking at 400 or 500. And the people that are up here at 700, 800, they're probably not making the moves, and again, just hampering supply. So that's very different than probably what PBD, Grant Cardone, a lot of these major players are saying, and I'm nowhere near them, not that I'm saying I'm one of them. So what do you wanna do in order to make money in this economy or make money in the housing right now? There is gonna be a position, and there are gonna be some factors that we're gonna be looking at to say, okay, house prices, no matter what price point, are gonna drop because there's gonna be forced sales. This is a conspiracy theory that I came up with. I haven't seen it online yet, but the big banks are trying to get their money back, and there's probably collusion between the big banks, the Federal Reserve, and the government. The big banks put out money at 2%. Inflation is at 8%. They are losing money on all the money that they put out. The Federal Reserve continuing to raise rates so that people can lose their jobs. That's literally how you taper inflation, is people lose their jobs. So when the big banks, Wells Fargo, Bank of America, Chase, has billions, trillions of dollars out in the economy, Fannie and Freddie has billions, trillions of dollars out in the economy that they let people borrow at 2%. When that money is devaluing at 8%, they got to get their money back somehow. The Federal Reserve has to get their money back somehow. So what you're starting to see, a trend that not a lot of people are talking about, is consumer debt piling on and increasing more than we've seen in our lifetime. Credit limits went up when there was lower rates because people can afford to pay more. But because those credit limits went up, people are borrowing more now at 20, 29% interest. And I believe that the consumer debt crisis, along with a huge influx of unemployment, could really cause the next collapse of the housing industry. And what it's gonna be is people aren't gonna be able to afford even their low monthly payment. Because if you have crippling credit card debt and you have a $2,600 mortgage, you're probably gonna pay that $2,600 mortgage. This debt's gonna continue to pile on. So even if you're at a 2% rate, what are you gonna do? You're gonna have to be forced to do something because you have $200,000 in equity. And so what people are gonna do is they're gonna try to leverage the equity positions in their home before house prices drop, right? Then they go and they pull money from their equity. Now they tack on a 6, 7, 8% rate, right? We do loans with no documentation. Someone calls us, they want $200,000 in equity, no problem, but their rate's gonna be 8.25. Their payment of $2,600 goes to $4,600, but they get 200 racks. That then goes off to pay off all their credit card, their cash flow probably improves, and then they have 100,000 left over. They either go that route or they sell their house and they move to a different state. Right? If you're in a big metropolitan area, guy's in his 50s, right? Lost his job, he's got 300,000 in equity, he's got $100,000 in consumer debt, and he's either goes bankrupt or sells his house even though it's at a 2% rate. This is a forced sale. If the consumer debt continues to climb and unemployment rates rise rapidly, now you're gonna see the housing market become an ATM for people. People are gonna be forced to sell, therefore increasing supply. It'll probably offset all of the current demand that's in the marketplace, and it might exceed demand. And when supply exceeds demand, that's when prices pull back because the buyers hold the power. That is my prediction on how you can prep yourself and what markers to look out for to say, okay, the housing market is about to crash. But if you look at my video about the auto industry collapsing, that's gonna be first. You're gonna see big increase in consumer debt. Then you're gonna see the continued fall of the auto industry. And then the housing market is gonna start to dwindle. There's gonna be an increase of desperate sellers. The buyers are gonna hold position. They're gonna come in, they're gonna buy homes. And this is all gonna happen within 6 months. If this doesn't happen by October or November of 2023, then house prices aren't gonna drop. And quantitative easing is really gonna come in hard right about Q2 of 2024. And you're gonna see rates in the 3s and 4s. And then you're gonna see house prices appreciate faster than we've seen in a long time. And right after November 2024, when the election's over, you're gonna see the Dow have the biggest day ever, but you're also gonna see the beginning of the next climb of home prices. So if you wanna position yourself, you gotta position yourself today, and you can either buy now and take the risk of a potential small dip, which I don't think will happen if you're in the right price point, but otherwise, it's gonna be about positioning yourself to take a look at the markers, increase in consumer debt, increase in unemployment, and then get ready to make some money because the housing market's gonna crash.